Okay, let's look at some of these slides here as well for week 2. We're still in receivables, and you guys need to understand that when we estimate bad debt expense, we will be looking at the percent of sales method, which is also known as the income statement approach. There's 2 other methods, but we'll start with this one. First of all, this method assumes that a fixed percent of all your credit sales are going to be uncollectible. In other words, those customers who pay for those are not going to ever pay you. So they're going to be uncollectible, but of course you don't know which customers they are yet. You just have some historical data that maybe it's 2%, maybe it's 3%, maybe it's really good and it's less than 1%. But either way, you just assume that a fixed percent of all your credit sales will never be paid because customers won't or can't pay you. Okay? So what happens is, again, you take a bad debt expense and you would debit whatever number you come up with in this system to be an expense in the period in which these sales occurred. Okay, and of course the corresponding credit would be a credit to this contra asset account called allowance for doubtful accounts, and this is subtracted from the gross receivables, which is a regular asset account. Therefore, the debits from accounts receivable minus the credits from this contra asset account will give you your net receivables. Okay, now how we come up with these numbers, we're going to go over it in a little bit. Okay, you take the credit sales, and that would be given to you in a problem, and then you simply take 2% or 1% or whatever percent they give you, and that number becomes this number here, the actual debit and credit in this journal entry here. Okay, we'll do an example of that in just a moment here. Okay, the percent of accounts receivable method, also known as the balance sheet method, is a little bit different. You estimate what the balance sheet should read at the end of your estimate here, and by what the balance sheet should read, we mean what the actual accounts receivable balance should read, and then you make a journal entry or a journal voucher to have the allowance for doubtful accounts match that estimate. Alright, so what this means is same journal entry here, but what happens is that you are actually going to have to figure out what the balance sheet or what the accounts receivable should read at the end of the day, or at the end of the counting period, and then you have to figure out how to find the debit and credit here to make that fit. Okay, we'll do an example in a moment. The final method is analysis of receivables, and this is in your book, and you'll have to look for the aging accounts receivable schedule, which we'll go over in a little bit. This is where you actually figure the ADA per aging schedule, and you make a journal entry or journal voucher to have the allowance for doubtful accounts match it. Okay, let's start with a practice problem here. First of all, this company here, Genron, has a beginning balance of accounts receivable of $22,500 at the beginning of the period. Then we have credit sales of $45,575 over the course of the accounting period. We receive $38,500 from customers that are paying off accounts that they owe to Genron. Okay, and the allowance for doubtful account has a credit balance of $250 at the beginning of the period. Okay, so what this means is reconstruct the accounts receivable ledger to find the new balance of accounts receivable. So what I'm going to do here is I'm going to read the problem, then I'm going to go into a solution for it. Okay, so we'll look at what that AR ledger looks like, and we'll find the new balance. Okay, if we use percent of accounts receivable with 2.5% estimated, what journal entry would we need to make at the end of the period? Well, we'll have to show you that method. And then finally, if we use the percent of sales method, what journal entry would we need to make at the end of the period? Okay, so that's the problem. I hope you understand what it's asking you, and we'll do a solution in a separate bit that follows this one immediately.